For decades, Bed Bath & Beyond looked untouchable. It wasn't flashy or innovative, but it was everywhere. Huge stores, endless aisles, and familiar blue coupons arriving in the mail year after year helped embed the brand quietly into everyday American life. People didn't talk about Bed Bath & Beyond the way they talked about Apple or Amazon. They didn't need to. It sold the most basic things imaginable: towels, bedding, kitchenware, storage boxes. Products tied to life milestones like moving out, getting married, and furnishing a home. So when Bed Bath & Beyond collapsed, the question wasn't just what happened. It was how a company selling things people will always need could fail. And the answer matters because this collapse was not sudden, not accidental, and not unique. We like to imagine corporate failure as dramatic: a sudden shock, a disruptive competitor, or a single fatal mistake. But most large companies don't collapse that way. They decline gradually while still appearing functional. Sales soften, margins compress, costs rise slightly. Executives reassure investors that the problems are temporary. Bed Bath & Beyond shows how systems fail while believing they are still in control. This pattern isn't limited to retail. It appears in entire industries, in careers, and even in household finances. Decline almost always feels reasonable until it becomes irreversible. To understand the collapse, you have to understand why the model once made perfect sense. Bed Bath & Beyond was built for a specific era of consumer behavior. Shopping was physical. Driving to big box stores was normal. Browsing was part of the value. The stores were intentionally overwhelming. Endless choice created the impression of abundance. If you needed anything for your home, you assumed Bed Bath & Beyond had it. The coupons reinforced that perception. They didn't just lower prices, they created a psychological reward. Customers felt clever, not cheap. For years, this system worked beautifully. Revenue grew, foot traffic stayed strong, and the company expanded aggressively, confident that scale itself was a competitive advantage. But embedded inside that success was a fragile assumption that customers would always be willing to trade time and effort for choice. Consumer behavior began shifting long before Bed Bath & Beyond responded. Shopping became faster, attention spans shortened, digital convenience reset expectations. Customers no longer wanted to browse, they wanted clarity. But Bed Bath & Beyond misread the signal. Instead of curating selection, it expanded it. More SKUs, more clutter, more visual noise. Stores became harder to navigate, not easier. The company confused choice with value. What once felt empowering began to feel exhausting. Customers didn't want to walk through endless aisles to buy towels. They wanted to decide quickly and move on. That friction didn't create outrage, it created avoidance. And avoidance is far more dangerous than dissatisfaction. When customer effort increases while alternatives reduce friction, relevance erodes quietly. E-commerce didn't just introduce a new way to buy products, it changed how people think about shopping. Amazon didn't win because it sold better products, it won because it eliminated effort. Search replaced browsing. Logistics replaced location. Speed replaced abundance. Bed Bath & Beyond treated e-commerce as an add-on instead of a core system. Stores remained the center of gravity, and digital was secondary. This created a fatal mismatch. Retail stopped being about proximity and became about ease. While competitors invested in logistics, data, and fulfillment, Bed Bath & Beyond continued relying on physical dominance and promotions. By the time leadership acknowledged the shift, customer habits had already changed. And habits, once broken, are incredibly difficult to rebuild. Coupons, once the company's greatest weapon, became a structural weakness. Customers stopped asking whether a product was good. They asked whether it was discounted enough. Purchases were delayed until coupons arrived. Urgency disappeared. Pricing discipline collapsed. Margins shrank, inventory piled up, and discounting became permanent. The company wasn't driving demand anymore, it was chasing it. When incentives turn into expectations, removing them feels like a price increase, even when it isn't. What's often misunderstood about this collapse is that almost every actor behaved rationally. Executives pushed promotions to protect revenue. Landlords demanded rent on oversized stores. Suppliers pushed volume to maintain shelf space. Customers optimized for discounts and convenience. Each decision made sense in isolation, but together they reinforced a broken system. No single actor caused the collapse. The system did. And systems fail when incentives reward short-term survival over long-term adaptation. Under mounting pressure, leadership made a bold pivot into private labels. On paper, the logic was sound. Higher margins, more control, more differentiation. But the execution ignored customer psychology. People didn't come to Bed Bath & Beyond to experiment with unknown brands. They came for familiarity and trust. When national brands disappeared from shelves, customers felt disoriented. Confidence collapsed. In retail, trust is built through recognition and consistency. Once that trust is broken, customers don't complain. They leave. The most dangerous phase of decline isn't anger. It's silence. Foot traffic declined slowly. Online conversion lagged. Inventory mismatches worsened. There was no dramatic backlash. Customers simply changed habits. And once habits change, recovery becomes exponentially harder. This is the moment when decline becomes structural. As sales declined, financial pressure intensified. Debt grew heavier. Cash flow tightened. Operational flexibility disappeared. The company entered a classic retail death spiral. Lower sales led to more discounting. Discounting reduced margins. Lower margins cut reinvestment. A worse experience led to even lower sales. At this stage, even good decisions arrive too late. Retail systems depend on constant reinvestment. When cash flow breaks, the system collapses. By the time Bed Bath & Beyond attempted serious restructuring, the environment had already changed. Customers had moved on. Competitors had locked in habits. Digital expectations were set. The brand still existed, but relevance was gone. And without relevance, scale becomes a liability. Large stores turn into fixed costs. Inventory becomes risk. Legacy systems become anchors. Bed Bath & Beyond didn't fail because of Amazon. It didn't fail because of inflation. It didn't fail because people stopped buying home goods. It failed because it misunderstood what business it was actually in. It thought it was in the product business. In reality, it was in the convenience and trust business. And it lost both. This story goes beyond retail. It's a lesson about systems that stop listening to behavior and start defending legacy. Success creates habits. Habits create blind spots. Blind spots destroy adaptability. Bed Bath & Beyond didn't collapse because of one catastrophic decision. It collapsed because of many small ones, ignored, delayed, and rationalized. That's what makes this story a warning, not an anomaly. Understanding these failures helps us recognize fragility early before decline becomes irreversible. Thank you for watching the Atlas Economy Report. We appreciate your time and we'll see you in the next report.